안녕하세요. 미국주식으로 은퇴하기 미주은입니다. 미국 주식에 투자하고 계신 분들이 꼭 만나고 싶어 하실 만한 미국 주식의 고수분들 혹은 각종 산업 분야의 전문가들을 제가 여러분들을 대신에 만나 뵙고 그분들의 훌륭한 인사이트를 들어보는 시간 미주은이 대신 만나러 갑니다가 방송되는 날입니다. 오늘은요, 조금 특별한 방송을 준비했는데요. 최근 CNBC 뉴스에 등장할 때마다 최고의 시청률을 기록하는 루펀즈의 매니징 파트너 진 머스트를 모셨습니다. Hi Jin, how are you?
Doing fantastic. Great to be back.
It has been a while since we spoke last time. How's everything with you and your family?
Everybody's doing fantastic. Thank you.
There have been a lot of requests from my subscribers to invite you back to my channel. Thank you so much for joining us today.
Thank you.
The for the audience, it is 6 a.m. in your time. So I guess you are one of those early birds, is it right?
I do. It's actually 5 a.m. Where I'm
Is
at
it?
today, and I make it a rule. I'm always in bed quite early. I would just say that this is I think it's important to be in bed early, and of course that means always getting up early.
All right. Well, maybe I should follow your lifestyle because I believe we are in the same age. I believe from last time. I will.
51. Yep.
Yeah, yeah. 51. I'm 50, so we are almost the same.
Nice.
Um, so you have a very healthy lifestyle.
Keep it simple, yeah. Don't take the bait at night when you're tempted to watch one more video. Just say no and get some sleep. I think it's paid off. Before 2020, I used to travel and didn't have the benefit of sleeping as much, and I find it quite just mentally, you're just in such a better place when you get sleep. I mean, it's
Mhm.
obvious, but it's a discipline though. Trying to create time for space for sleep. It's also a huge luxury to have
Mhm.
the ability. A lot of people have to work two jobs, and they can't afford they just don't have the luxury of sleep. So highly recommend it. I always like to say is that your day starts the night before.
Absolutely. Yeah, yeah, yeah. I totally agree with you because I had this bad habit. When you go to bed, I open YouTube and watch your video.
Oh, nice.
That
You can turn it off. That's okay.
sure will do. Um, can you kindly introduce yourself to the audience who did not watch our first collaboration last time?
Sure. Gene, I'm a managing partner at Loop Funds. We've been around for 5 years. The team that I have been building Loop Funds with, we've been together for over 15 years, and we've been researching and investing in transformative tech, both in the public and private markets. And so we have multiple funds
Mhm.
that really try to address where the world is going. We are a curious bunch, and we obsess about how technology is changing the future. We also, at certain pitch points, obsess about what's going on in the near term, what the Fed's doing, what's going on with the economy, and I think we're in a period now where we're thinking about both of those, not
Mhm.
only what's going on with the future of tech, but also what's going on in terms of the economy and the Fed.
Mhm. I have visited the website of Loop, and there was one saying we invest in frontier tech companies, automating the world and building new ways to experience it. So you just explained why you pay attention closely to tech companies. Do you also believe that there are bigger investment opportunities in the technology sector?
I do. I've been, tech has been a part of my investing career. And so I genuinely believe that if companies are not growing, they're dying. And so tech, just by nature, by its transformative nature, by its gaining a market share nature, has a growth dynamic to it.
Mhm.
An obvious example, of course, is what's happened with Tesla. The auto industry was effectively a dead industry, and it's a large industry too. It's a $2.5 trillion addressable market.
Sure.
That, to put that in a perspective, is that the smartphone market is about a $1 trillion market. So we have something that is 2.5 times the size of the smartphone market. But that is an example of a market that would not be appealing to us, the auto industry, but it's very appealing when you put it in the context of tech transformation, because it creates these new companies and new business models, potentially more profitable business models that create investment opportunities.
Sure. Yeah, let us talk about Tesla a little bit later. But today, considering the current market situation, I think we need to start with macro storage first. I would like to listen to your expectations regarding inflation and recession. First of all, when it comes to inflation, do you see we can see that the oil price has gone down more than 20% in the past months. Do you believe the inflation has peaked already?
Today, middle of July, my sense is that it has peaked. I think that the number for June will show an acceleration from what we saw in May. The CPI number in May was 8.6%. I suspect that it's going to be higher. I think that the market generally believes it's going to be higher too, because those oil prices peaked in the middle of June. So there is going to be a dynamic. One thing that is a little bit comforting about this CPI number is that investors, I think, are going to be focused more on the core CPI number. The core CPI last month, for month of May, was 6%. In the month of April, it was 6.2%. So it actually showed an improvement. The core CPI excludes essentially energy and food. It's, I think, a better reflection on what the Fed can actually control. That I do believe needs to show an improvement, and will show an improvement. I suspect it will be 5.9, a fractional improvement. So the one silver lining to this CPI number, a lot of anxiety around it, comes out on July 13th. A lot of, I think one silver lining is that people will be more focused on the core number. And even if it's an ugly number for the underlying, the general CPI number, I think the Fed, most importantly, is going to start to say, yes, it's hot, but it's not as hot because things have started to improve. And where that leads us ultimately for July 27th, during the next Fed meeting, I think probably leaves us at 75 basis points again, with some commentary about potentially pausing after that.
I see. So we are on the process of picking up, and at least when it comes to the core CPI, we might see some downturn in
I
the
think
near
we'll see
future.
another month of improvement. Another piece to it too is just a lot of the economic data in the U.S. has showed some decelerations. We're, of course, seeing commentary from big retailers about growing inventory levels. There just are starting to see some signs of some slowing. And so I think that you put that together, and I think that that should yield a core CPI number that is a slight improvement. And the market is hyper-focused on every 1/10 of a basis point here.
Yeah.
And so we are, I think I'm optimistic that we're going to start to show some improvements. That said, we're sitting in front of what is going to be, I think, a wild and quite negative earnings period for a lot of these companies.
Yeah, sure. You just mentioned the negative period for earnings. Let's talk about the recession risk then, because last Friday, just a few days ago, we have seen the June job report showing very strong labor market. But on the other side, Atlanta Fed GDP now, a tracker is indicating a minus growth for the second quarter. So we have two different indicators going to the opposite direction. Do you believe soft landing is possible at all?
No, I don't believe a soft landing is possible. I don't think the market is expecting that. I don't think the equity market is expecting a soft landing. In part because I think one of the reasons why that labor number was better than expected is because there still is a labor shortage. And so there still is some room to make up on those hiring, while the overall economy is starting to show some signs of slowing. It's just a very difficult dynamic to try to engineer a soft landing. Part of the reason is that I just feel like the spike in rates, we're just starting to see the impact on that. And the big spike came, of course, in the middle of June. And so we're, call it 3 weeks into that. And that has a profound impact on, I mean, it really hits hardest at the top, the most expensive goods, homes, and vehicles and cars.
Mm.
And when I think we're just starting to see that. We saw last week that the inventory of homes, it's been declining for the last couple of years. We saw it start to move up for the first time. You're starting to
Okay.
see more price reductions on homes. All of this has a trickle down effect on the broader economy. Specifically, you look at home starts, you start to see a decline in home starts. You've heard some of the home builders talk about some of the challenges that they're seeing,
Mm.
and that impacts less home starts, impacts everybody, impacts commodity pricing. There's a lot of people who are employed there within that industry, and the same in the auto industry. So you start to see these higher interest rates can have really a profound impact, not to mention
Mm.
businesses that are starting to think about expanding, that now these rates are going up. Going from a 2.5%, that's where it was. That was a 30-year mortgage
Mhm.
a year ago, going
Yeah,
from 2.5 to 5.5%. That is a significant jump for
of course.
a
Mm.
typical buyer.
Mm, mm. Right. So you are expecting that there could be a recession, and some of the investors are worried that because of that recession risk, we might experience a major bear market similar to a dot-com bubble in the early 2000 or a global economic crisis back in 2008. What do you think about this kind of a pessimistic opinions? Do you see that big drop from this point forward?
I've been negative for a better part of a year, and I think that we're getting close to the end of the negativity despite all of that. Despite the fact that we're likely in a recession, I think that the market view, the flashlight of the market looks at this point into 2023 in 6 months in advance. And so that is one piece that is somewhat comforting here, is that to answer your question, do I believe that this could be another 2000? Let me just quickly talk about what happened in 2000.
Sure.
The market was down 75%. The NASDAQ was down 75% in 2000, 2001, and 2002.
Mhm.
2000 was a horrible year. I think it was down like 40%. And at that point, probably a lot of investors said, like some myself say now, that we're close to an end. And then you're hit with another down, call it 30% year, and then a down 25% year. And so that is a quite concerning analogy. The challenge is that in 2000, the forward price to earnings growth, that was in 80 times. We're right now, the NASDAQ right now is at 21 times.
Mhm.
And it bottomed, the .com bottomed at about 18 or 19 times. And so we have more companies essentially in these high growth markets that are more profitable than we had in 2000. And I
Mhm.
think that that has a measurable impact, and kind of, I think, softens what potentially this downside could be. I think there is more downside. All that's optimistic, but I think we're not at the bottom yet.
Mhm.
And
Mhm.
the reason why we're not at that bottom yet is that I think we are squarely in front of, in the next few weeks, what's going to be just a really disappointing earnings period. And I
I
think that
see.
the commentary could spook and scare some investors to think that this recession is going to last longer than most think.
I see. So when it comes to a multiple, we are already at 21 times for the Nasdaq, which means maybe the downside risk is limited, but we still have a earning issue. So for next at least 3 months, we might have some earning shock from different companies, and we might go down more. But which means we are bottoming up then. Yeah, that is a part of the bottoming process.
Correct. We're getting close to the bottom, and you bring up important point is that price to earnings is price and earnings. And if we're talking about some downward earnings revisions during the June earnings report and the outlook for September and December,
Mm,
that stocks can continue to go down. So I think that investors should. This is not investment advice,
mm,
but I think that my view is to think about this in the context over a 2-year period. And I think that over the next 3 months, we're going to be kind of placing the bottom in the market.
mhm,
And I think the setup for 2023 is good, and 2024 is more neutral. But 2023, I think the setup for tech is good. But yeah, we're not there yet. But basically, every company is going to have something negative to say about September,
mm.
and it's game theory, but they would be foolish not to say something negative. And so I think that, yes, some of that gets priced in. And that's why I think that you can start to nibble away at some of these positions, because that's where I could be wrong, is that all this negative commentary comes out and the stocks go up.
Sure. When you were on my channel back in April, you said you were holding 50% cash. Are there any changes? Are you still holding 50%?
We have just in the last couple weeks started to deploy more. I would say fractionally more,
Mhm,
but consider it at um, at one point we actually increased our cash position just after we talked. I think we took it to 60, and I think we're back down to 50. So we've deployed in the last few weeks. But I think that kind of you want to know how somebody thinks, just look at their portfolio,
mhm,
and that really cuts to the essence of where they're at. And I think we're starting to move for the first time in a year, essentially starting to be more positive. But we're not. We've had opportunities. There's a theory of just go all in right now, and we're not there either. And so our view is we're going to get a chance that we can buy these cheaper, but we could be wrong. All this negativity could be priced in, so we wanted to start to take some action before then.
mhm, Excellent. Because, yeah, last time your decision to hold the 50% cash was a really excellent decision, I would say. Very timely,
Appreciate that.
yeah, decision. And that's why maybe many of our audience want you to back to my channel.
Oh, nice.
Um, Let us move on to individual stock stories now. Last time, you remember that when I asked you that what stock you would like to buy for your child, you chose Apple without any hesitation. What has changed with the Apple since then? Anything good or bad? Any particular news you want to share?
I think that just directionally, the macro is more negative. I think that Apple is in a place where they probably are going to have some cautionary commentary about their September quarter. I
Mhm,
suspect that the June quarter is going to be fine. I suspect that they don't give formal guidance, but they give informal guidance on their conference call. And I suspect that what's changed is they're going to talk about some leveling of growth, especially in the Mac and iPad.
mhm,
I think that the other piece that's changes or hasn't changed is since we spoke, is I still think that this company, and this is I think more important or equally important, is even though they are going to have some impact from a recession, this is still a stable business and generates cash. I mean, it's a $2.5 trillion company, so it's a high valuation.
mhm,
However, they're going to generate about 50 or 60 billion in cash this year with a B.
mhm,
And that's a sign of strength, and a sign of strength is important because it allows them to make investments. When you generate that much cash, you can do a lot about building towards the future. And I think one of the other pieces that's new since we last spoke about Apple was one announcement, a little subtle announcement at WWDC.
mhm,
And I'll stop well before the line that they're going to do. Apple will make a car, but what they're doing in I think automotive is quite remarkable. The next version they have of CarPlay that's going to come out essentially in 2024. They're saying late 2023. is going to move from the center console to taking over the entire instrument console. And what that's referred to as root functionality. It's something that car makers are turning over. And there's 14 car makers, major car makers, that have already agreed to this. And it shocked me. And the reason is that a lot of the core experience for inside the vehicle is going to be really influenced by Apple, and Apple's going to get a lot of credit for it. So really, to put it all together, one thing that has changed regarding Apple is, I think whether or not they make their own car or do something in CarPlay, I think the automotive opportunity is significant for Apple. And I think that that is something that can really change the growth rate. One final thought.
Mhm.
If they do a car, they want to do a car, don't say they're going to do a car. If they do a car, it can have a material impact on their business. If they get 10% of the share of automotive, it's a big
Mhm.
number, but they have 20% of the smartphone market. If they get 10% of the share of automotive, that would essentially double their revenue of the company. This has the potential to be bigger than the
Mhm.
iPhone. And so I think that's something that if you're a long-term investor, you can sleep well knowing that the company wants to pursue those types of investments.
I see. You just mentioned the potential inside CarPlay, and already 14 car makers are working together with the Apple. When it comes to the mobile market, we can see that, as you just mentioned, 20% is with Apple, the other 80% is with Android. So which
Mhm.
means the Google should be able to develop similar functionality for the this car play model, and they can have bigger portion of the market. What do you think? Because theoretically, it's possible, no?
It is possible. I think that when it comes to CarPlay and automotive, um, they do have greater in the US. It's 50%. They have 50% share of the phone market,
Mm.
and CarPlay is more than 50. It's almost 100% of vehicles are offered with the option, and I would guess that it's probably something like 60 or 70% of cars are sold with
Mm.
that option. But you do, in order to really benefit from CarPlay, you have to have an iPhone. I mean, that's there's Google Auto, so that there's an Android version of CarPlay that
Mhm.
a lot of car makers offer too. But what the reason why it's positive for Google too on that front, but the reason why I think it's noteworthy is it just underlines the struggles that traditional car makers are having in technology
Mhm.
and creating a tech experience that consumers want. And the theory that car makers can just flip a switch and turn it on and become more relevant in the next version of cars, electrification and autonomy, just because they can turn it on, just because they've been there for 100 years, I think is misses the point. I think actually that heritage is holding a lot of these car companies back.
Sure. Yeah, yeah, talking about the heritage from automobile company, let's move on to Tesla then, because Tesla also has gone through a very challenging time due to another lockdown in China and other macro regions. It was also reported that Elon Musk was implementing some cost reduction measurements by cutting some of the headcounts as well. And last week, you tweeted an article saying Tesla's growth story is misunderstood. What did you mean by that? Can you please explain your logic over there about
So
Tesla?
we looked more into the Tesla deliveries in the June quarter, and just to give some context, in the May quarter, the deliveries were up 68%,
Mhm.
68. In the June quarter, they were up 28%. So just a measurable deceleration. And they didn't break it out. Tesla did not break it out. They just said that they hit record production in the month of June,
Mhm.
suggesting that they're through that bottleneck. And I think that there's a further investigation about what's the true number, what impact Shanghai shutdown. So the China Car Passenger Association puts out numbers that are relatively reliable. And essentially, if you back out those, they would have grown at 69% deliveries at 69%. That assumes that everything that should have been produced in Shanghai would have been sold and delivered. I think that that's a fair assumption given the backlog. It's coming up on 9 months right now to get a Tesla. So essentially, you can get a better sense. Those 22 days of shutdown in Shanghai were significant. And if you put that in the context of, so what is 69% growth? It is essentially the same delivery growth that they had in in March.
Mhm.
And separately is that gap between traditional auto continues to be wide. I think that's really important. We have a saying at Loop called the 180-pound rule. And basically what it means, I won't go through the heritage of the saying, but what it means is a number is only relevant when it's in the context of another number. And so in this case, what are the relevant numbers? One relevant number is what was the delivery growth in March? 68, 69 in June on an adjusted basis. The other relevant number is what's happening with other car makers, traditional car makers. And at least in the US, those car makers were down in the June quarter an average of 22%. And so that put a gap of, if you add the two together, call it, that's a 91% lead that Tesla has on deliveries. And if you look at that lead in the March quarter, it was 75%. And in December of 2021, it was 90%. So what essentially we're seeing is that the Tesla growth story is misunderstood, that it's somehow quickly decelerating. It is as strong as ever.
I see. Yeah, excellent point. I want to talk about the Meta platforms a little bit this time, because PE ratio of Meta has gone down to 13 times now. So do you believe it is a once in a lifetime opportunity for the investors, or do you believe it is a beginning of another value trap we have witnessed from Intel or IBM? Which side are you on?
Well, we own a little bit of Meta, and so I would put us on the positive side. I don't think this is a value trap. I think that I think the PE is misleading with Meta. I think it's actually higher than 11. I know mathematically it is there, but I think the earnings are probably going to come down when they report their June quarter and guide for September because of the slowness in the ad market. And so it's probably really trading right now at like 16 times, where the rest of big tech is, or 15 times, and the rest of big tech is trading at 18 times. So it's not an obvious pound the table. I think what is impressive to us, or what is encouraging to us, is two things. First is it's hard to build a network at scale, and they have caught almost 40% of the global internet population uses a Facebook Meta property on a daily basis, which is remarkable. It's hard to replicate. We think that TikTok eventually is going to get banned in the US, probably in the next year. There was rumors of that a couple years ago. We think that that will ultimately come to fruition. And last is, and most importantly, is Zuckerberg's commentary recently about cost savings, about he's never talked about expenses. He's never talked about tightening the belt. And now he's talking about that. And that's encouraging, especially given Sheryl Sandberg's moving on, and she's been the one who's typically been the one that's more cost conscious. What that means is that investors over the long haul should take some comfort that he's not going to spend outrageous amounts into the metaverse. And so earnings matters in these types of environments, and that's just encouraging.
I see. So a couple of things. First one is a competition side. TikTok's influence is getting smaller and smaller.
Well, I think it's strong now, but we think it's going to get blocked in the US.
Blocked. Okay. So totally gone then. And second of all, as you just mentioned, Meta was the company which never talked about cost control before, and then now
Zuckerberg did.
Zuckerberg, they're trying to tight their cost expense, which means as a shareholder, we might expect some good earning result in the foreseeable future then.
Correct.
That's great. This time about Google, I read an article last weekend stating that Google had proposed splitting up its advertising tech business to appease government regulators. And to make it worse, the Department of Justice looked not very satisfied with the proposal, and they still want Google to sell some of its assets. So how big do you think is this investment risk related to regulatory problem? Should we consider it when we invest in Google?
Google and I think all big tech, I think Amazon and Apple, I was surprised to read the story that Google was essentially giving in and trying to find ways to work more closely with regulators. I thought that they would fight this to the very end. It sounds like they're fighting it now again, but I think it speaks to the intensity level that these companies have had. If you're going to say which companies are most negatively impacted, when they were on Capitol Hill, when these big tech companies a year ago were spending time on Capitol Hill, we had always ranked it as Google and Facebook are kind of at the most risk, and then Amazon, then Apple. And I think that's true. Those are dynamics that are still true. I suspect that we have one analog to look at is what happened with Microsoft. And when there was talk of breakup, and they did make some changes ultimately, it caused the stock to there was some negativity around it for a long time. With Microsoft, I think there was a bigger issue around innovation that they had. It was less about the breakup, but that does create some headwinds. We like Google. We own a little bit of Google. I think I would just say this is that's the wild card. That's the piece that makes me a little bit uncomfortable. It doesn't change my broader view that they're going to be in a good place longer term, even if they divest some of these. But that is something that we just don't have a good view of what impact it's going to be.
I see. For the beginner investors, they are always worried what would happen to my shares when a company split up. What is the usual case? What happened to my stock?
Yeah, usually what would happen is you'd get what's referred to as a stock dividend. So they would have some calculation for every share of Google that you own. You would get a fractional share in the new company, NewCo. So I don't know what that ratio would be, but just as a hypothetical example, is that for every share you might get 0.2 shares in this new company, and so if they split it out, essentially you would have two stocks that would be trading on their own merits. It's the most complicated piece around it is related to just creating structure around. Essentially, you have to take a business that is now part of a big organization and make it a standalone. They have their own leadership right now, even inside these big organizations, but there's compliance and there's a lot of legwork around that. So, but that's basically what happens is you get a stock dividend.
I see. So let's say in case Amazon is splitting up with the e-commerce and AWS, maybe we will own two different company stocks then, according
Exactly.
to the percentage. So theoretically, there's no damage then.
In theory, you can build a theory that there's no damage, and that's the most likely theory. There's a theory that there's unlocked value, that by splitting these up, it allows businesses that have not had higher multiples to be re-rated higher. Usually that doesn't happen. It's usually a wash. And then you have a theory that part of the business becomes just kind of forgotten by investors. So, but in general, I would think of it as a neutral. It should be a neutral.
I see. Thank you for the your opinion. Last time we did not talk about any semiconductor companies. For your information, Korean investors love semiconductor companies. I think a part of the reason is because we have Samsung in Korea. What are your favorite semiconductor stocks in US at this point, and what would be the reason you like them?
So we're investors in Intel. I thought just from so we like Intel. We like it based on onshoring. I think just maybe from a highest level regarding semis is that what happened with Micron, even though that's not semiconductor, it's kind of memory and storage related. I think was really encouraging. They guided down for on an August quarter is their next quarter. They just reported their what it would be an April quarter. They got it down by 20%, and the stock closed down that day by 3%. That's encouraging when you see that dynamic.
Mhm.
So I think that from a high level, I think that some of the negativity is getting priced into some of these chip makers. From our view, what's appealing about Intel is that there is this, I think, onshoring dynamic. I think what we've seen in Eastern Europe, we might have talked about this last time, it probably was too fresh, but around what's happening with oil, I think sets a precedent to what could happen in the semiconductor space, specifically around TSMC and what's manufactured in Taiwan. And of course, this strategic ambiguity that Taiwan operates under has been a wonderful balance over the last 40 years, but that probably doesn't last forever. And more importantly is that I think you're going to see the U.S. and some Western companies not wait around for something to happen. I think that there's going to be a really sense of being proactive, especially around advanced semiconductors. And that, of course, leads to some of the U.S. Congress giving money to Intel to invest in chip production in the U.S. Now, that hasn't been approved yet, but it likely will be approved, and it's going to take a few years for that campus to be built. But I just think in general, you're going to see this dynamic in chips around onshoring, and that's why we own Intel. TSMC has factories in the U.S. too, but I think you're going to see greater investment from U.S. and Western Europe in their own technology infrastructure, because from an economic and security perspective, they just can't be beholden to Taiwan.
I see. Actually, this onshoring trend was initiated by COVID virus, right? So, in your
Yes.
opinion, they will continue to dominate the semiconductor market.
Another company that we're optimistic about, it's a private company, it's called Redwood Materials, but they also kind of benefit from some of government aid and essentially building the battery supply chain in Western Europe or the US.
Next one, I want to move on to cloud SaaS company, because I hardly see you talking about SaaS companies before. Is there any SaaS company stocks, in your opinion, which might have a bright future?
Well, the one that we consider a SaaS that we do own is Zoom. And I think that, it trades at right now about a 6.5 times multiple, which is kind of essentially the new revenue multiple on next year's revenue. That's kind of the new SaaS multiple. It used to be 10, 12 times a few months ago. So it's not like it sticks out as an obvious company to own based on valuation. But we do think that when you go from working remote 5 days to 1 day, you still maintain your Zoom subscription, and there's still just a lot of value in it. And we suspect that they have pricing leverage. And so that's really the extent of our focus on SaaS right now is related to Zoom. There's another company we're not invested in, Peloton. There's a case that you could argue this is kind of a software content type of company. They have a big hardware business that's pretty controversial that they're losing money on right now. But that's one that trades at like 1 times their subscription revenue. But there's a lot that still needs to play out there.
Sure. Excellent. What about the FANG companies? Among FANG companies, which stock do you would you buy at the moment if you are a trader with a short-term perspective?
Well, I think that all these companies are going to be under pressure for this earnings period. I think it's going to be a messy commentary around September. And so I think that if you're looking for a 2-week trade, a 3-week trade, I think that my sense is just to stay away. This is not investment advice. I think if you look at a view of into 2023, there's more reason to be optimistic. And which companies do I think you can own? We talked about Apple's a great one. I think Amazon's another company which we're going to start to see in 2023 some positive earnings revisions. They've made some healthy investments, hefty investments in infrastructure. They invested $60 billion last year in infrastructure. That compares to Microsoft at, I think it was 20 billion, and Google at 12 billion. So they have they've really they overbuilt essentially. And Jassy has talked about this, but that would be another company that I would kind of flag. And I think the unique part about Amazon is that what they have cannot be replicated. Meta, what they have something that's unique around global directory, this connection of almost 40% of the daily internet users. But some things can, at a low cost, can come and compete. TikTok's a great example. You just don't have that when it comes to Amazon. Trying to build an infrastructure around delivery and the top of the funnel that they have with their retail business is just, it's really difficult, almost impossible. Imagine going to all these different municipalities and cities and trying to provision for these new warehouses and to do the hiring around this infrastructure. I think it's something that it's not very techy, but it is a massive competitive advantage that Amazon has. And so that's the other one I would flag. And the last one kind of that still orbits around there is Netflix. And we still have some apprehensions about Netflix.
Excellent. Thank you. I think it will be the last question now. Since 2020, a lot of new Korean investors have entered the U.S. stock market with a big hope that U.S. stock market should be able to continue its steady performance for the foreseeable future. Because looking back the history, the people investing in the U.S. stock market have been able to enjoy a very healthy return, let's say almost 10% on average. Do you believe this success story can continue for next 5-10 years, or it will be a different from now on?
When it comes to tech, it's not investment advice, and my belief is that this can continue in tech. I think that the expectations, it's all about growth, like we talked about in tech. And I think that U.S. tech companies still do a great job of innovating. And I think that the investors recognize that, because I think that the growth is going to continue to be healthy. And some of them can be the big tech companies. Some of them, it could be Tesla. I think there are smaller companies that are powering that too. So I think when you put all this together, I would put it in the context that we're not going to get a big bounce back like we saw in March of 2020. Unfortunately, those expectations should be removed. But I think if you look at this in the context of 5 or 10 years, especially in the context of tech, I think that the U.S. market's a great place to be. I'm biased. I've spent my career in this, but I just believe in innovation, and I believe that a lot of these companies are continuing to lead the way, and I think the stocks will respond appropriately.
Excellent. Hopefully, the outlook will follow in the future. Let's call it a day, Jin. Thank you so much for sparing your precious time and wonderful insights with us. I really appreciate it.
Thank you for the time.
Thank you. Yeah, have a wonderful day ahead.
Thanks. Bye-bye.
Thank you. Bye-bye.